This is a presentation called Bitcoin, Blockchain, and Cryptocurrencies, Understanding the Opportunities and Risks by me, Daniel Amelli. There's a lot to cover here. This is just a look at the overview of the slides we'll be discussing, trying to at least give you an understanding of the important elements that go into Bitcoin and blockchain and give you an opportunity to see where you want to learn further. First off, let's say, why are people excited? Why people care about Bitcoin? Well, they care because the price went up. They might not know what it is, but they know, oh, isn't that thing that the price went way up and all these people became rich? Yeah. So if you look here, you say the most recent Bitcoin bubble with the price shooting up to almost $20,000. On this chart, we can see back to 2012. It doesn't look like anything exciting was happening back there. But that's because this spike here at the end of 2017 completely blows the whole chart out of perspective. So let's look what it looked like in earlier bubbles. Here's the 2013 bubble. Notice that the price axis is completely different. We had a mini bubble followed by a major bubble going over $1,000, followed by a long decline. And not that many people remember this one, but this was the 2011 bubble where Bitcoin shot up to $30 before crashing down as low as $2. As you can see, there's a repeating pattern here as people pile in. Now we're going to talk a little bit about the history of Bitcoin. There's also the prehistory of Bitcoin, such as the people and the technologies that came together to help make this thing happen, but that's beyond the scope of this presentation. So, Halloween 2008, Satoshi Nakamoto publishes the Bitcoin white paper, a short description of the system he's intending to build. The Genesis block, the start of the Bitcoin blockchain, begins January 2009, and it includes a text of a headline from the London Times, Chancellor on brink of second bailout for banks. This helps anchor the blockchain in time, that the Bitcoin blockchain then could not have been started earlier than this particular point. But also it is a reference to the global financial crisis that's going on at the time, that it made people lose trust in banks and think, could we build an alternate system, one that doesn't involve bailouts, one that involves personal responsibility. And then in 2010 was the first documented case where somebody paid for bitcoins, paid with bitcoins, in this case pizza, trading 10,000 bitcoins for 2 pizzas. 2011 Bitcoin traded over $1 for the first time. 2012 was the first reward halving, where the amount of bitcoins being issued per block was cut in half, as said programmatically, back in 2009, and can't be changed. In 2013, Bitcoin traded over $1,000 for the first time, and in 2014, the major exchange, Mt. Gox, or Mt. Gox if you like, collapsed, leaving a legal mess which is still being disentangled today. 2015 was when hype started about blockchain as a business buzzword, where many different companies started saying, could we potentially use this technology that underlies Bitcoin for many other non-financial purposes? In 2017, there was the launch of the Bitcoin futures on the CME and the CBOE, and Bitcoin traded almost $20,000. And this is where the Bitcoin got a large boost of mainstream media attention. 2018 was the crypto winter, where the price of Bitcoin went down significantly, as well as the price of many other coins went down often as much or even more. And you have a period where it's harder to raise funds. 2019, now we're seeing security token offering and stable coins becoming the topic of interest. And history doesn't stop here, it continues. This is simply what we can include briefly in this presentation. So what is Bitcoin? It's a cryptocurrency started in 2009 by someone identifying as Satoshi Nakamoto, which could be a man, a woman, or a group of people, and still remains unknown. Bitcoin with a capital B refers to the whole network itself. Bitcoin with a lowercase b refers to the units of currency, the symbol being BTC. So Bitcoin is decentralized. No government or company or person is in charge of the system. People can try to influence it, they can change it, they can propose their own direction for it, but they need to achieve different degrees of consensus in order to have those changes take place. If there isn't a consensus for a change, it could result in a fork, which I will cover later. So Bitcoins are purely digital. They're not a physical coin. Articles like to show a metal coin, for example, but that's not it at all. No, those are generally speaking purely commemorative and don't contain any kind of private keys or value. But a Bitcoin can be divided into 100 million pieces called Satoshis in honor of Satoshi Nakamoto. Only 21 million Bitcoins can ever exist. Approximately 17 million have been produced so far as of 2019, with the remaining 4 million to be slowly produced over the next 100 years or so. Bitcoins are produced by mining. So mining is meant to be analogous to gold mining. You have the problem of how do you initially distribute a currency in a way that people perceive as fair. If Satoshi had allocated all the coins to himself or herself, then it's unlikely that other people would have been interested in trying to get those coins. So if you think about gold mining, the gold starts out in the ground, and then anyone can go either choose to try to get some of the gold or not. And the early gold is easier to get, and it becomes more difficult and more challenging to get more gold as time goes on, as the low-hanging fruit has been picked. So the Bitcoin mining, specialized computers verify the transactions in the network in the hopes of solving the next block. I'll cover this in more detail later. While it was originally started with and intended to be done by hobbyists, individuals using their own computers, now most of it is on an industrial scale with machines built for the purpose. Mining is an important part of the security of the network, as well as the distribution of the newly produced Bitcoins themselves. These blocks of transactions then form the Bitcoin blockchain. Now you might ask, what's blockchain? Blockchain is the technology underlying Bitcoin. Each group of transactions, Bitcoin transfers between entities, is bundled into a block, assuming that it's valid, timestamped, and then linked to the previous blocks. The blockchain is necessary for Bitcoin to maintain its decentralization and security. The blockchain defines the record of who owns what Bitcoins, although it's not attached necessarily to identities. It's public and immutable. Immutable means that it can't be changed. Once something has been written in the blockchain, there isn't a proper procedure to alter it. It's intended to be resistant to being altered. However, blockchain is now used to refer to all these other non-financial, or rather non-cryptocurrency applications of the blockchain. While in the Bitcoin use case, it was intended for recording the transfers and ownership of Bitcoin, the use of blockchain now could be meaning to represent many forms of information. So it could be to authenticate, track, transfer all kinds of goods, as well as people can make their own blockchain, multiple blockchains with different features or parameters, or even private blockchains. So you may have heard decentralization. What does that mean? It means that there's no central authority. The power is distributed amongst different people. It doesn't mean necessarily equally, but it does mean that there is not that one central choke point. So the blockchain is part of what makes decentralization work. Centralized systems don't need blockchains. So if you have a person who wants to keep their own records, they don't need to have their own blockchain for this. It would be redundant. So blockchains is a data structure, and it's more resilient, and it's a part of the decentralization. But you can have things that are decentralized without blockchains. However, decentralized systems, while they're more resilient and they're less decisive, there's some duplication of data and information, and they often have issues with speed and scalability, meaning how quickly can people get the state of the network and how many users can be supported. Anonymity versus pseudonymity. Anonymous means that there is no name, but pseudonymous means that there's a fake name or an alias. Even though the word pseudonymous isn't used often, a lot of people are familiar with it. If they created an account on MySpace or older social networks or instant messaging, they often selected an alias for themselves, or perhaps in a multiplayer video game. Whereas with networks like Facebook or LinkedIn, they might be using their real name. Whereas anonymous means that they wouldn't have any particular name attached to themselves at all. So the Bitcoin system is pseudonymous, much like Satoshi Nakamoto. Presumably that is not the creator of Bitcoin's real name, but is the name they chose in order to identify themselves in terms of collaborating with other people in the early days. So pseudonyms can be linked back to people's real names, or they can be probabilistically linked back to it. Bitcoin transactions are public and permanent. So Bitcoin is not anonymous. This is really important. Bitcoin is pseudonymous. You can see that there was a Bitcoin transaction from a certain address to another address, but you don't inherently know whether that represents someone paying themselves, paying somebody else, or something else entirely. It's possible to have privacy while using Bitcoin. However, it does require deliberate effort, and there are ongoing work to try to improve the privacy, because you do need some degree of privacy in order to run a business or donate to different political organizations or pay money and so on. There are altcoins such as Monero that have built-in privacy by default. However, there are trade-offs to this in terms of the resource consumption. So let's talk a little bit about game theory, which is related to Bitcoin and an important part of the system. Because you don't have this top-down structure, so you have to think, how do you have a system where people are incentivized to do something positive? People respond to incentives, and you can often predict people's behavior based on the incentives. A system is stable if you have an equilibrium, and the incentives incentivize people to stay in the equilibrium. People can either cooperate or not cooperate. But if you want people to cooperate, then you want to create a system where the incentives encourage them to do so. So consider the prisoner's dilemma, where two different people who both participated in a crime are arrested, and they're threatened that there'll be severe penalties if they don't testify against the other person and admit to the crime. So in that case, both of these prisoners then have an incentive to basically betray the other person. So this is unstable. However, consider driving on the left versus the right side of the road. In this case, it makes sense to be agreeable and to cooperate, because even if you have a personal opinion about what the correct side of the road to drive on is, if you're somewhere where everyone else decided to go the other way, you have an incentive to just go along. You have a very strong incentive to cooperate because you don't want to get into a car accident. So, a centralized system, you need reputation, you need law enforcement, you need an entity that's in charge that can make decisions. But with decentralized systems, you're relying on these financial incentives. The Bitcoin miners are incentivized to mine. They're paid in Bitcoin for securing the system. And cryptography is used to make sure that people have access to what they're supposed to have access to and nothing else. Then also consider the mining investment game. You have the question of, should you buy specialized mining equipment because it will give you a payoff in terms of Bitcoin? You're paying for the machines, and then the machines are going to produce some amount of Bitcoin. However, the amount of Bitcoin they produce and the real world value of the Bitcoin depends on, among other things, how much other people decided to invest in mining. Which means that if more people view mining as likely to be profitable over the next few months, then they're more likely to buy mining machines, which means that mining may be less profitable. But if they perceive that mining will be less profitable the next few months, they may not invest in more mining machines, making mining more profitable. So mining is unstable in that sense because you want to participate when other people choose not to. However, over the long term, the difficulty adjustment leads to a stabilization of the amount of mining relative to the value of Bitcoin. So what is mining? Well, it's analogous to gold mining. It simultaneously secures the network, validates transactions, and produces new Bitcoin. Who can mine? Anyone can mine with access to computer hardware. Anyone can start mining if they want to, and they can stop mining whenever they want to. People can jump in and jump out. It's open to anyone, anywhere in the world, provided they have some computer hardware, electricity, and internet. However, it's competitive. The difficulty of Bitcoin mining adjusts over time. So as more people mine with more sophisticated machinery, the network itself adjusts the difficulty of the target. The other factor is the halving, which means that approximately every 4 years, the total amount of Bitcoin that is being mined every block gets cut in half. Again, this is pre-programmed, and it's another factor that is often neglected when considering mining. It's not free money. The difficult part of the mining is the hashing. Getting the transactions, validating them, and putting them into a block is the easy part. The hard part, and this is intentional, is to find a valid hash. Basically by trying different inputs into the hashing algorithm to find a resulting hash that meets certain criteria. Bitcoin uses SHA-256, Secure Hashing Algorithm 256. It's an existing, well-tested standard. Originally, mining was conceived of as one CPU, one vote. A regular person with a regular computer could mine just like anybody else. As it became more competitive, people realized, well, can we use GPUs, which are the chips in graphics cards or video cards intended for gaming, and they realized that those were more efficient for the hashing algorithm. And then by 2012, people realized that this was important enough to actually make special computer chips for this purpose and nothing else. Because these other chips are still somewhat general purpose. So people designed ASICs, application-specific integrated circuits. Computer chips, in this case, intended just for doing SHA-256 and nothing else. So they're extremely efficient at this one thing. And then once ASICs were widespread, is no longer viable to mine with the previous kinds of chips. So while this was originally small scale, now many operations are large scale and quite industrial. Warehouses filled with ASICs and are often located in remote places because there's access to inexpensive electricity. For example, a hydroelectric plant that's not located near any people. However, there still are people mining on a small scale. However, they typically want to join a mining pool where they're combining their resources, because if they didn't do that, then they would have trouble finding a block. The benefits to mining are you get paid in the cryptocurrency that you're mining. So if you mine Bitcoin, you get paid in Bitcoin. And you're directly participating in securing the network. However, there are costs involved. You have to, in this case, manufacture or buy the ASICs. You have to pay for electricity. And the ASICs, however, take up space, and they produce heat and noise. And then there's the physical security, which means that the ASICs could be targeted for theft. Public key encryption. Public key encryption was developed because you have the problem of how do you securely communicate on an insecure line. Older forms of encryption made the assumption that people could communicate securely prior to communicating on an insecure line or via insecure mode of communication. But public key encryption is a major step forward. So instead of having one key that both encrypts and decrypts, with public key encryption, you have two parts, a public key and a private key. The public key is used to encrypt, the private key is used to decrypt. The idea with the private key is it should never be published. It really is private information and never leaves the person's possession who has it. If the person wants to prove ownership of the private key, then generate a signature with it. So this dates back to the 1970s, but has many applications and is now used to secure even regular internet traffic as well as critical banking applications. So while the math behind it can be somewhat complicated, I'll give this example. Consider a king who wants to communicate an official order to a distant province. The king wants to send a letter to the distant province, but he's worried that someone else could try to alter it along the way. So the king has a ring that only he has, and then he seals the letter with wax and presses the ring into the wax. Then when it is received in the distant province, they can see that it has the imprint of the ring of the king, and the wax has not been broken, and then they know that this has been sent from the king directly without being altered. So this imprint is like a signature where the ring is the secret or the private key. Now consider if the king, instead of sealing the letter with wax, had simply placed the ring into the envelope and sent it. This would be the wrong way to do it because the secret is now leaving. So while providing the actual secret proves you have the secret, it's not the correct way to do so. Many systems on the internet these days were built the wrong way, where people are providing their secret or password. Bitcoin is built on doing it the correct way, but you do have to actually secure your private key, and I'll get into that later. Consider also another analogy, safety deposit boxes at the bank. Each one has a number. They all have input slots on them. So if you give your number to somebody else, then they would be able to place money through the slot into your box. And you could have a key or perhaps a number, another secret number that you would key in to be able to open the box. So you have one number that represents the ability to send it, another number that allows you to access those amounts. So the Bitcoin address is essentially equivalent to the public key, and the Bitcoin seed words is equivalent to the private key. When you want to participate in the Bitcoin network, you, or rather a machine working on your behalf, is generating randomness used to create the private key, or seed words. Then from there, it can create a public key that corresponds to that, and essentially an address that other people could then send to you. So you can give other people the address, and then they would be able to send funds to you, but only you can access those funds. Only you can send the funds from that address somewhere else. Hardware wallets were created for the purpose of securing these private keys. They're dedicated devices. Regular computers are not secure. They're trying to do many different things. And if you want to do one thing well, you do one thing well. So there's a number of devices such as the Trezor or the Ledger wallet, typically costing up to $100. The beautiful thing is the private keys are generated on the device and they don't leave the device. So usually in conjunction with a computer or a cell phone, but sometimes independently, you can generate a transaction and then sign the transaction on the device using the private key, and then broadcast the signed transaction. Because the private key is never exposed to a general purpose computer, it has a very, very high level of security. And the nice thing is, this is an easier way to get high security. There are other ways to securely store private keys, such as cold paper wallets or the Glacier protocol, but those are beyond the abilities of most regular people, whereas the hardware wallet is a fairly easy use device that gives an extremely high level of security. So the Bitcoin blockchain is a primary layer where you can make what's called on-chain transactions. You can send the Bitcoin back and forth as well as record certain pieces of data. However, there are secondary layers you can build beyond it. So Omni is a secondary layer with the most well-known thing on it is called Tether, a stablecoin. Counterparty was one of the earlier secondary layers, allowing people to create tokens that were secured by the Bitcoin blockchain. Liquid is a secondary layer meant for exchanges or other large entities to quickly rebalance funds between them. Lightning is a secondary layer which allows streaming payments or micropayments between parties, and then these can later be settled on the Bitcoin blockchain. Rootstock is a secondary layer intended to add more sophisticated smart contracts onto the Bitcoin blockchain, emulating the functionality of Ethereum. The advantage to a secondary layer is that you can add more functionality, such as faster transactions or smart contracts, without risking anything in the primary layers. A problem in the secondary layers would not damage the primary layers. The primary layers can stay more secure and more conservative. ICOs, initial coin offerings. So this was originally intended to sound like IPOs, initial public offering. However, it's quite a bit different. With an IPO, typically the company has been around for some time and is fairly easy to value. But ICOs are more like early stage venture capital or even an angel round. It's a type of funding that's been enabled by cryptocurrency. The advantage is that it allows projects to raise large amounts of funds from investors, small and large, all over the world. The most noteworthy example is the Ethereum ICO of 2014, where Ethereum raised $18 million while they just still had an idea. This allowed them to actually get the funds to build Ethereum, which then became much larger. By 2018, billions of dollars have been streaming into ICOs of all different types. However, this is it's biased in favor of the people raising the funds. The people putting in money may be receiving tokens in exchange for this, but it's not necessarily clear whether those tokens will accrue value, whether the projects will be successful or built at all, or even if projects are successful, they don't have the same kind of claim on whatever is built the way stock or bonds would give them. There's an issue of utility tokens versus security tokens. So in the US, there's more restrictions on securities. So a number of ICOs have claimed that their tokens are utility tokens, in that they would be just simply used as part of the system, and as opposed to a security where it would be an investment intended to create a return. However, with a utility token, then the case for investing is much weaker, because presumably people could then buy the utility token as needed, as opposed to years in advance. However, now there is more interest in security tokens that are definitely, clearly securities. Altcoins. This is a catch-all term for all the cryptocurrencies that are not Bitcoin. However, there's many different things of wildly different properties. So just to run through it a little bit, you have tokens which are on other networks. So for example, under Ethereum, you have the ERC20 tokens, a wide variety of those, which live on Ethereum and require some amount of ether to transfer. If there's a problem with Ethereum, then these tokens are affected. You also have non-fungible tokens, such as the ones that are under the ERC 721 standard, the most famous of these being CryptoKitties. Non-fungible tokens are like collectible trading cards, or characters in a game, or other kinds of virtual items, and these could be used to represent things that are not fungible or different than each other, unique. These are more difficult to value. They need to be valued individually, and they may not have liquid markets for them. Stable coins are coins intended to maintain a stable value with respect to the US dollar, or perhaps the euro or gold. The advantage to stable coins is that they don't have the price volatility, so they're more predictable, and they may be better in terms of tax consequences for ordinary commerce. Stablecoins are often part of a system where there's another non-stable coin that functions along with it, absorbing some of the risk. STOs are security token offerings, which are in some ways more like just regular stocks or ownership in some kind of joint entity than they are cryptocurrencies. However, the ownership is represented by cryptocurrencies, allowing them to be transferred more easily. However, these are more likely to have a situation where the final ownership is determined by the legal system as opposed to possession. These are less likely to be structured as bearer instruments. Then there are forks. Just to be clear, many coins are forks of another coin's code, but in this case, these are forks of blockchains. So ideally, the blockchain is linear, where each block builds on the previous blocks. However, you can have people deliberately create a fork. So they're creating a new blockchain that incorporates the same history as an existing blockchain, but then continues in a different direction, like a fork in the road. The advantage to a blockchain level fork is that you are inheriting the history and you are automatically starting with a number of users. So while some of the people who then end up with possession of this newly forked coin might want to sell it, there are other ones who might take an interest in it, and you're at least starting with a user base greater than 0. Related but different is airdrops, where people who have existing balances in another coin are given access to a new coin for free, or they may have to directly claim it, but only in the event that they have the token or they take the effort to apply. These can be ways to draw attention, and there have been a number of major coins that have given out substantial sums this way. There are also coins that are connected to exchanges, such as Binance's BNB token, or Huobi's token, or KuCoin shares, where the coins are intended to be used with a particular exchange and offer some kind of benefit, such as reduced fees in that case. These need to be valued a different way because they are tied to a company with specific revenues. However, like other centralized coins, it's possible that the company that has control over them might change the terms at a point in time, or could potentially go bankrupt, or potentially decide to issue more tokens. Different coins sometimes have different mining algorithms, or sometimes they have the same mining algorithms as other coins. It's possible that when you have multiple coins in the same mining algorithm, it can create an unstable situation where they're competing for mining power, and it raises the risk of 51% attacks on coins that have a less dominant share. So Bitcoin has the SHA-256 mining algorithm, and then Litecoin uses the script mining algorithm, and then other coins have branched off into their own. There are, however, some coins that do not have a mining algorithm at all. They're non-mineable, as well as this is also the case for many tokens where they're already on another blockchain, which is being mined. So proof of work refers to the security system of Bitcoin, where the miner is showing that they did a certain amount of work by finding a difficult to find hash. So they're showing that they must have spent a lot of time finding different hashes in order to find the rarer one. Proof of stake is an attempt to move away from this, where in order to have the authority to issue blocks, you are proving that you own a number of coins in the system. The advantage to this is that it doesn't require mining hardware, and it seems to have some stability in that you need to be invested in the coin itself in order to be able to mine for the coin. However, there are downsides, such as this has not been proven to work in a decentralized way in an adversarial environment, as well as there are different theoretical attacks against proof-of-stake systems. Delegated proof-of-stake is where the owners of coins are voting for a limited number of people to be able to issue blocks on their behalf, and then they could change who they are delegating as these block issuers. This is seen in systems such as EOS. Ethereum is currently proof of work, and it is trying to transition to a proof of stake system. There are also coins that introduce certain governance models where people who hold coins can then be voting for who is in charge, or certain kinds of development, or a direction of the coin, or a change in the issuance of it. While these are interesting experiments, it's possible that these introduce new kinds of complications and problems that are as yet unforeseen, as predicting the outcome of governance can be difficult. And with many of these projects, you see that they're not one person, one vote. They're one coin of ownership, one vote. So if the distribution of coins is very unfair, then the voting is likely to be very unfair as well. There are competing schools of economics, Austrian versus Keynesian. Keynesian is dominant in many parts of the world right now, where Keynesian economists believe that the government and central banks should be adjusting money supply, inflation, and interest rates in order to keep the economy moving smoothly. Keynes favored the short term over the long term, saying, in the long run, we're all dead. The Austrian school, in general, tends to prefer sound money where the government does not have control of the supply. So inflation is when money loses purchasing power, and that can be due to the printing of additional money, or it could be due to other factors in the economy. Deflation is when money gains purchasing power. Again, this can be due to multiple reasons. Inflation and deflation are both thought to be bad, and Keynesian economists feel that deflation is particularly harmful. Most people would agree that a small amount of inflation tends not to be that bad, but inflation beyond a certain point can be very, very detrimental, as it makes it more difficult to run businesses or to save. The US government has been fortunate to have relatively low inflation in recent times, and certain countries around the world have had numerous severe bouts of inflation, and in some cases hyperinflation, where the inflation feeds into itself, leading to outrageous levels of inflation and then usually a collapse of the currency. Lending is affected by this. With inflation, then lending rates have to be higher in order to compensate for the change in purchasing power. Deflation can often make lending very difficult, or it can increase default rates. Bitcoin tends to align more naturally with the Austrian School of Economics. Of course, then there's the question of what is money itself? It's something that people see all around them, but they don't necessarily think about. Just like the fish asking another fish, what's water? So money tends to serve three functions. As a store of value, meaning that you want to be able to save value in order to spend it later. As a means of exchange, if you want to then transfer value to somebody, money is a good way to give it to them. And as a unit of account, if you want to price labor or goods, then what do you measure that in? You measure it in the units of a money. It's nice to have money that is all three of these things, but in many cases, money that is in use only solves one or two of the purposes, and then you end up using something else for the payments or the units of account. In a country with very high inflation, they might use a foreign currency like the dollar as their unit of account. And they may use, say, gold or cans of beans as a store of value, but then use the local currency as the means of exchange. This creates overhead, but they may need to do this in order to keep things functioning. So money itself generally is not valuable. Value is created by people trading across time and space. If one person is on an island by themselves, they have no use for money. When you have two people on an island, they can trade with each other, making their lives better. And they can usually keep track of the favors that they owe each other. But once you have a large number of people, money is a useful way for people to make sure that they're contributing something commensurate to what they're consuming. Commodity money is money where the money itself has some value aside from the money value. So for example, sardines or packs of cigarettes in a prison, or gold coins, where the gold coin might have a value written on it, but even so, that gold can always be melted down and used for something else. Commodity-backed money is where you have potentially pieces of paper, but then those are redeemable at a fixed rate for gold, such as the US dollar prior to 1971. Fiat money is money where the money itself doesn't have value except by government decree, where it forms part of the basis of the system, but in the event of the collapse of the government or excessive printing of the money could then lose value. Fiat money has been very successful and worked in many parts of the world. However, there are certain downsides to it. It's hard for any entity to resist the temptation to be able to make more money, seemingly creating value from nowhere, but actually diluting the value of all the other money that's in circulation. And I just want to touch on global reserve currency. There are different currencies that have been the global reserve currency around the world at different points in time. Currently, it's the US dollar, which means that other countries paying each other might use the US dollar to denominate the prices as a unit of account, or even as the means of exchange, because there are liquid markets, and they know that that will allow them to continue trading with other countries. When a country has access to the global reserve currency, this gives them certain privileges because it limits the detrimental effect of printing money because it's absorbed globally as opposed to just in the country itself. So there are ideal properties of money. There are different lists of adjectives. This is the list I came up with. And just to give some examples, I am comparing it and judging Bitcoin, the US dollar, and gold on these terms. However, different people might agree on the important properties or how well these meet these properties. So you want money to be durable. You want it to last. You don't want to save something. You don't want to have your savings in fresh fish and then find out later that those fish are rotted away. One of the reasons gold is desired as currency is because it meets a lot of these properties, and durability is one of them. If you place a gold bar on the ground, it doesn't do anything. It doesn't go anywhere. It doesn't melt. It doesn't rust. Scarce. You need a limit to the total quantity. Sand doesn't make a very good form of money if there's just plenty of it floating around. You need some kind of limitation on the amount in order for people to value it. Available. You need people to actually be able to get their hands on the money to be able to spend it. If you were just using extraordinarily high value items as money, then it would be very difficult for people to do that. Divisible. You want a currency that you can split into smaller units. So, for example, gold can be divided into smaller units to some degree. The US dollar can be divided down into pennies in terms of cash. And Bitcoin, as I mentioned, can be divided into 100 million satoshis. If you're trying to pay people with non-divisible things, such as iPhones, then how would you pay as an amount that's smaller than that? You also want money that's recognizable. You want the person to be able to tell how much something is worth immediately by looking at it without having to do some kind of auction or complicated research. Fungible means that each unit of the currency is just as good as each other one, so that people are not concerned with the particular history or quality of the exact thing that they're being paid with. Portable. Can you move it around? Can you send it to the other side of the world? Well, it's certainly more portable to carry a certain value of gold than the equivalent value of copper. However, it's still pretty difficult to make an online payment with that. Whereas Bitcoin has a terrific portability. Non-counterfeitable. Can you make sure that you can always distinguish the real thing from a forgery? The beautiful thing about Bitcoin is that it can't be counterfeited. If you have legitimate Bitcoin software, then anything that is fake is just simply not valid. Gold has historically been very difficult to counterfeit because of its extremely high density. Only in modern times has a tungsten cored gold bars been produced that are more difficult to detect as fake. Irreversible. You want transactions to not be reversed by the person who made them. You can build a reversible payment system on top of an irreversible one, but not the other way around. Acceptable. Can you actually spend this in a wide variety of places? Do people actually take this as payment? And decentralized. No person or group has total control over the system. You want people to control their money, but not everyone else's. And perhaps this isn't good in and of itself, but it helps ensure other beneficial properties. Regulatory. So different countries have reacted to cryptocurrencies in their own way, some of them being more supportive, some of them banning outright, and some of them being more neutral. Of course, this changes all the time, so you should look up what the current map and status is for your country. However, it seems like bans are not the right approach because it's likely to chase businesses out of the country while still allowing black market activities. Centralized exchanges and on-ramps are more vulnerable to regulation. Large companies want to follow the rules, but the blockchains and decentralized apps are not so easily regulated. There's the phrase that's been going around, regulatory arbitrage, which refers to the fact that a company that wants to do something will then look for a country that is more favorable to them. So we've seen some companies relocate to Switzerland, which has been more favorable to cryptocurrencies and ICOs. Within the US, which has quite an influence on the rest of the world, there's a number of different regulatory agencies that have taken different positions. The SEC has been involved where they thought certain ICOs, or coins or tokens, were securities. The CFTC has stepped in where people have created derivatives related to cryptocurrencies. The IRS has said that people need to pay taxes on their cryptocurrency profits, treating it as property. And the Federal Reserve, which is responsible for setting interest rates and the US dollar in the US, has said that Bitcoin is simply not within their jurisdiction. Exchanges. You have different types of exchanges. So you have exchanges that are regulated, that are trying to follow all the applicable rules, as well as exchanges that are unregulated, that are trying to avoid following government-imposed rules. You have exchanges that are centralized, that there's one company, and then you need to connect to their servers in order to be able to do trades, and they're keeping their own internal logs of what customers deposited what amount of money. Then there are decentralized exchanges where the exchange is done on the blockchain, or it's done in a peer-to-peer way, or perhaps with some kind of escrow or moderators. Centralized exchanges allow for much faster trading at the present time, while decentralized exchanges are a bit slower, but could be more available in more places. Then most exchanges are custodial in that you are depositing funds to them, and then they are keeping the funds on your behalf, and then you can request withdrawal of those funds later. Some decentralized exchanges, or even Certain other kinds of trading like OTC could be non-custodial, where you keep the funds up until the exact moment of the trade. Custodial exchanges have been the biggest risk to people's continued possession of their coins so far, as we've seen many custodial exchanges lose customers' coins, go out of business, or in other ways, simply steal customer funds. Most cryptocurrencies are bearer instruments, which means that the person who has it has it. So if you think about if you owned gold coins, would you send them to somebody on the other side of the world for safekeeping? Well, if you did, you should hope that they were very well regulated and had a great reputation. But even so, you're still taking a much greater risk than simply keeping them yourself. Some exchanges offer fiat on-ramps in that they connect in with the traditional banking system, and then they allow people to easily deposit funds to them, or in some other way, such as connection with a Bitcoin ATM, for example, where they can deposit cash in exchange for cryptocurrency. Whereas there are other exchanges that do not have any fiat on-ramps, which means that the person must already have cryptocurrency of some form before they can trade. OTC is over the counter. It refers to a kind of trading, usually larger quantities, negotiating the trades where somebody who wants to buy is then matched manually with somebody who wants to sell by a trading desk. While less visible than other forms of trading, some companies have entered this space and have said they have connected billions of dollars worth of buyers and sellers. There are also derivatives. These are a product that's based on another product. So the cryptocurrency itself would be the base product, and then you could have futures on this, which allows someone to go long or short with leverage, and then options, such as calls and puts, where the person can then buy or sell or have the option to buy or sell based on certain conditions. Derivatives can be useful for managing risk, as well as gaining extra leverage. However, they introduce other risks, which I won't go into. With exchanges, you have to consider the liquidity. How many people are trading on the exchange? How easy is it to buy or sell? You also have to consider what are the fees and the fee structure. With some exchanges, you pay less fees if you're trading more frequently. What are the exchange's policies for coin listing or delisting? Many exchanges may charge teams behind different coins for the listing of them, or they may be listing or delisting arbitrarily, or having users vote on it, or considering other factors such as legitimacy or the potential properties of a coin. What is the jurisdiction of the exchange? Are they based in a certain country? Are they aimed at another country? Are they available to people in your country or state? Are you eligible to trade on them? Are they looking for institutional customers or smaller traders or larger traders? You also want to look out for wash trading, which is where people are trading, buying and selling in a way that nets out to try to create the impression of greater trading volume or more activity. Then there are liquidations. If you're trading with leverage, then you could be forced out of your position by an adverse move. Then there's manipulation, where somebody is trying to deliberately increase or decrease the price in order to create a favorable position for themselves. Spoofing is where people are putting in orders that they do not intend to actually trade on in order to make it look like the market is moving a certain way, or to try to get a reaction from other traders or trading bots. Trading bots are computer programs that are trading according to a fixed strategy. Then there are pump and dump schemes where people might coordinate purchasing and then selling a particular cryptocurrency in order to increase its price significantly for a short period of time. Then you have questions about the recognition of forks. If you have funds deposited with the exchange, not only are you taking the risk in those funds being stolen, but you may not necessarily get access to forks that are coming out from your coins. Some exchanges have recognized certain forks but not others, and some exchanges have decided to sell forks on behalf of users. So, coming back to the risks, there's technological. You could have a hard drive failure, you could lose private keys, you can back up them, but the backups could potentially be at risk as well. There could be a cryptographic weakness underlying the cryptocurrency that you're using. There could be a smart contract failure. The DAO failure, the DAO failure with the Ethereum cost people a large amount of money, as well as a bug with the parity multi-signature smart contract, which caused a significant loss of funds. There's also the risk of 51% attacks, where an adversary could get control of a majority of the hashing power for a certain algorithm, using that to attack a coin in order to reverse transactions up to a period of time, or to deny other people the ability to create transactions on that coin. The risks related to computer security, such as hacking or phishing, where the person is looking for credentials, or spear phishing, where it's a targeted campaign to try to get credentials or passwords from someone else, as well as malicious hardware, where something has been tampered with beforehand, or even somebody selling used equipment that may still have their personal information on it. There are financial risks, such as prices decreasing significantly, and then there are legal risks, such as a cryptocurrency being outlawed in your jurisdiction, or complications related to taxation. Then there are systemic risks, such as the governance failure with the coin, or the project being co-opted or taken over by some other entity or government, or simply project abandonment, where the key developers or leaders of the project are no longer interested or motivated, or move on to another project, or outcompeted, where simply another coin does what the coin you have is trying to do, but much, much better, leaving no niche for your coin. Then there's fraud, bad exchanges where they are hacked or lose funds, or in some way fail to return funds to users, or reversing transactions. Or, for example, if someone is trading in a peer-to-peer marketplace, then they could find that they've sent an irreversible cryptocurrency payment, but the payment method in which they received funds for the cryptocurrency was later reversed. This became an issue with early trading, where people were trading Bitcoin for PayPal and then found out that the Bitcoin transactions could not be reversed, but PayPal transactions could be reversed up to months later. Applications of blockchain. So you have the non-financial transactions in addition to the financial ones. First, you have, naturally, payments, but more importantly, you have identity. You can keep identities on a blockchain where a private key can connect to an identity, or potentially more than one identity, which would allow people to cut down on spam, or allow people to prove who they are and their track record. You can also use blockchain for authentication of goods, for keeping track of supply chains, for proving educational credentials. Quite a number of people have claimed that they had certain educational credentials that they didn't. And it is still somewhat costly to verify this. And with a standard on the blockchain, this would be simple and very hard to fake. Memberships and organizations could be on the blockchain, as well as rewards programs where people could then sell or trade different kinds of reward points or airline miles more easily. Blockchain could help with real estate records as well as the sale of real estate, for stock and bond settlement, for different kinds of applications of smart contracts. It could be used for lending, for insurance, for healthcare records, for patent licensing, music licensing, timestamping and notary functions, where you want to establish that a certain thing was done at a certain time, or a certain piece of intellectual property existed or was created by somebody at a certain point in time. The blockchain is far superior for that. There are already companies that are providing this kind of service, with them allowing people to put a record into the Bitcoin blockchain, or in some cases into multiple blockchains at the same time. You can use blockchain for different kinds of voting and governance models. You can use it for crowdfunding, whether it's more like a Kickstarter or even ICO. You can use blockchain for transparency and auditing, where you could see the real-time status of something, or you can see the flow of funds through a nonprofit organization. And you can use blockchain for non-fungible tokens, for unique items, virtual, that could be owned by somebody and then transferred. So what could happen in the future? Well, there could be mainstream adoption, more people, just regular people using this because it becomes part of the society instead of the cool new thing. Different kinds of financial products, traditional finance on Bitcoin, or Bitcoin in traditional finance, more legitimacy. You're going to see the code of different projects, including Bitcoin, continue to improve over time. Scalability is a challenge that the top people are working on right now. How can you get more people to be able to use this when the system still handle this? Privacy is being worked on, because you need a certain level of privacy in order for this to be a part of mainstream financial payments. And of course, just by things continuing to exist, you get a longer track record to make people more comfortable. And then you'll eventually see more behind the scenes usage, where cryptocurrencies will be used without people even being aware of it. It just might be simply the best way to help facilitate sending a fiat currency between one place and another. But it's important to be said, all statements about the future are inherently speculative, so we don't know what will happen. So what are potential paths you might want to take related to cryptocurrencies and blockchain? There's investing, trading, mining, learning, teaching, building, working in this space, or just simply using it. And here's some additional resources you might want to look at later. I'll post the links.